Are you taking advantage of the power of dividend stocks? Now, dividend stocks are really sought after during retirement or even leading up to retirement as a source to generate income. And in today's video, we're going to be looking at 3 high yield dividend ETFs to generate that passive income. Essentially, what you want to do is to supplement Social Security, you can actually switch over to a dividend portfolio or dividend stocks, which again, we're going to be looking at in long-term returns. Some of them do see some considerable growth, but overall, we want to check these out. First one we're looking at is the Wisdom Tree US High Dividend Fund. This, of course, is a large cap global stock, one that I haven't covered before. This is the ticker symbol DHS. Now, the ETF currently has a dividend yield of 3.5%, so a little bit lower than we traditionally see, even thinking of CD yields, things of that nature, a little bit lower on the side. I even have high yield savings accounts that are yielding 4%. But when you compare it to the S&P 500 that yields a 1.2, it is really a big difference. Now, the one with this one, even though it is a lower dividend yield, you are seeing a very concrete, fairly safe, large stocks that generate a lot of cash flow and companies that have a ton of money. When you start looking at oil, natural gas like Exxon, looking at tobacco company Altria, also looking at pharmaceutical leaders Abriv, they are really stable. They are companies that have been around for quite a bit of while and overall very stable. Now within this ETF, it does have a lot of different stocks, but the portfolio has 388 stocks itself. So we're not just going in with 1, 10, 20, 50. 388 stocks in this portfolio, which of those companies they have to have paid dividends over the last 12 months and have a market capitalization of over $100 million. So when we think about large cap, that's exactly what they're looking for. And they're looking for companies that are consistently paying dividends, which is crazy. Now, the big difference with this one, rather than weighted position in the portfolio by market cap, which is what we usually see, or by dividend yield, which is another one we see, it weights it by the total amount of dollars that are distributed in dividends, meaning the larger holdings that they have, the higher dividends, they're going to larger companies will pay out a higher total dividend. But because a company has a high market cap, doesn't mean it will pay out as much as a smaller company will. So very cool to think. So the weight is based it off one might call in this article, market cap of the dividend. Nifty way of balancing size and strength with the dividend yield. It is not all into just heavily into these larger companies. Now, this, of course, has a risk compensation, which return on equity momentum factor, it is relatively low when it comes to the stability. If the goal is to keep risky stocks out of the portfolio, this ETF is absolutely perfect because it has a very low risk overall. Interestingly, the ETF won't hold a top 5% of stock with the highest dividend yield. So again, it's not going to be concentrated in one single company. Seems kind of counterintuitive, but of course, higher dividends can reflect companies that are trying to draw in money or companies that are in trouble, really looking to cut payouts in the future. And that's not what we're looking at in this one. Second one on the line is Invesco S&P Small Cap High Dividend Low Volatility ETF. Now that is an absolute mouthful. Ticker symbol on this one is XSHD, might be the one. Now this, when it comes to a dividend, 6.9% dividend yield, which is incredible. Now it is small caps. Now with that being said though, small caps are perceived riskier than larger caps. However, in a dropping rate environment, mid cap, small caps do usually do exceptionally well. But if you're looking for a good payout at 6.9%, you are almost double what we normally see. And I mean, you're talking what, 4x that we see with the S&P 500, maybe even a little bit more, which is crazy. The index starts by selecting a pool of 90 highest dividend paying stocks within the S&P 600 small cap index. So we're thinking of 90 high yield dividend stocks that are in there. And of course, could be a little bit of a risk because these are smaller companies, but then it takes a second step to filter out some of the risk within the 90, but to eliminate. So essentially it whittles down the 90 stocks that we have to 60 by eliminating 30 that have the highest volatility. So now this fund, this ETF is down to 60 stocks and only 60 stocks in there. And then of course, if a stock has a beta below 1, they are going to remove it. So again, it really streamlines exactly getting these companies, mitigating some of the risk and making sure the volatility is not really perfect, but the risk is not super high when it comes to these smaller companies. So culting the list from 90 down to 60 with those low beta stocks really is intent to set off and really offset some of that risk with those high yields. And of course, with this one, it limits the stock in the portfolio, meaning from any single sector, it will not have more than 10 companies. So we make sure that we do have a little bit of mitigation there. And of course, some of this does come from the real estate sector. So keep in mind with the REITs. And the last one I'm going to talk about, and this is one that a lot of people have really, I've seen and I've heard about, the Global X Super Dividend US ETF. This ticker symbol is DIV. So this ticker symbol is dividend itself, which is kind of crazy. Similar methodology to the Invesco fund, but more of a concentration, holding only 50 stocks of a larger pool of companies. So when you think about 388 with that Invesco, down to 50 stocks that we hold in here. Now, of course, this is a little bit different because it tracks the sole active global super dividend index, which is a mix of high yield dividends offset by beta, setting out the 50 US list with the highest yields and also a beta of 0.85 or below. So again, when you start thinking of really the concentration, it also limits one sector to 12 of the 50 holdings. So you're not going to be tied into one sector and one sector only. That you're getting all of those dividends out. And of course, it sports a 5.6% very juicy dividend yield. Now, when you start thinking about the consistency with these dividend payouts, it really looks at a lot of the utility sector. It is the largest component, making up roughly 21% of this ETF, which is kind of heavily regulated by nature and stability. When do you think of infrastructure within the United States? Utility companies, all the utility sector is really something that we can't do without. The energy sector is the second slice, followed by the real estate sector. So when, again, you think of the infrastructure of the United States, this ETF does have a lot within there. Now, it's more concentrated just because of those 50 companies than the Invesco ETF. And of course, it is equally weighted, which I like. I don't like the market cap weighting. It can be a little taxing when you think all of your money is kind of in one place. This one is an equal weighted ETF, which rebalances. Every stock gets a 2% weighting. So think about that for a minute. Is you have 50 companies. Every company, when it rebalances at the end of February, you get 2% in the company. So if a company's going up, company's going down, they are going to rebalance this every single year, getting back to the 2%. So out of these three, honestly, when I think about the super dividend, you're talking 50 stock picks from a large pool of companies that are market capitalization with a minimum of 500 million, or you could go in with a much higher dividend yield with those small caps, getting a much bigger return. But again, I would probably put a little bit of a portfolio in there if you're doing it. And then of course, we do have the Wisdom Tree US High Dividend Fund, which is pretty good, 3.5%. Really mitigates a lot of the risk out there. Or you could do what I do. I invest personally in the HD. That is the ETF that I do carry. Even though it's been down and it's been trending down, the yield within there is still very solid. And as I approach retirement, getting the ETF and generating the dividend income makes a really big difference, because that is going to be the supplement for Social Security when we do get into those retirement years. So guys, that's going to do it for today's video. 3 high yield dividend ETFs to generate that passive income. If you have some of your favorites, definitely let me know down below, and I'll catch you in the next video.